Welcome back to the Investor Professor podcast. This is Dr. Ryan Peckham, and this is episode 81. On today's episode, we're going to talk about the inflation numbers that came out, the bank earnings that came out. We'll talk about what earnings you need to look for in the coming weeks and how they can impact your portfolio. But our main topic today is going to be investment strategy. How do you come up with an investment strategy? How do you stick to an investment strategy? And I think you'll enjoy this one because one of the biggest mistakes, well, I'll hold that till we get into the episode. So get your mind right. Let's get to work.
You dropped this.
Welcome back to the show, everybody. Want to thank you for joining us for another week here. I also want to say thank you for the reviews on Apple Podcasts and Spotify. We're getting a lot more likes and comments, and I just want to tell you thank you for that. Sometimes I say this at the end, but I know that we're busy. Sometimes you don't make it all the way through, so I did want to tell you thank you. It does matter. It does help. It helps us out tremendously, so thank you. So here we go, another week in the stock market, and a good week. A good week in the stock market. S&P 500 is now up 4.16% for the year. NASDAQ's already up 5.85% for the year. So looking a lot different than we did a year ago. So we'll see if this can continue. One of the main reasons this happened this week is we had CPI. Remember, that's the Consumer Price Index. That number came in better, meaning inflation is slowly dropping. The next Federal Reserve meeting is going to be on February 1st. It is now expected that they're going to raise interest rates 25 basis points. So when you consider all the interest rate hikes that we had a year ago, 25 basis points just doesn't seem that bad anymore, does it? And so it's all about perspective here. And you see the market basically pricing in that the Federal Reserve is getting closer to just pausing rates and seeing how things, manifest over the next couple months and seeing how this data comes in. But the data that we've gotten over the past couple months is positive from the sense that inflation looks to have peaked, is now starting to come down. And the question will be, will that continue? And as we get more data, we'll see if this is, if inflation is sticky in different areas, but it looks like, used cars are coming down, new cars are coming down. And so demand is definitely curbing a little bit here. And of course, there are reports of more and more layoffs. You see technology companies are laying more employees off as we go along. And so hopefully we will have what's called a soft landing here, where the market kind of slows down, but it doesn't hit a recession. Now, this past week, we had bank earnings on Friday, and that started the earnings season for us. So this is going to be, companies are going to be reporting their fourth quarter earnings from now till the next couple of weeks. It really starts to get heavy, not this next week, but the next. We're going to have technology earnings, and we will, of course, talk about those. But the bank earnings were... I thought it was interesting when the bank earnings came out. They came out Friday morning before the market opened. And the initial reaction was that the market was down and the market didn't like their earnings. But in the morning, when companies report, you just get the numbers. So you get their earnings per share, you get their revenue numbers, you kind of just get like the highlights of their earnings. And there really is no perspective on those numbers. It's just that the analysts compare them to what happened last year. And you have maybe hedge funds and big-time money managers that are using algorithms to trade. And so the initial reaction is that they sold off. They didn't like the numbers. They didn't maybe like something they saw. And then all of a sudden, you have the earnings calls midday, mid-morning, and the banks actually get to come on. They get to talk about what they're actually seeing, what they see coming up in the next quarter or two. And so all of a sudden, these earnings they get a different perspective and the stocks start to trade up. And most of the bank stocks that reported on Friday closed higher after their earnings call. And so this is a very important point, especially going forward. There's too many of us that trade off of just kind of that initial response on these earnings. And a lot of times that initial response is not the right response. And so it's so important to listen to the conference calls or at least read the transcripts, hear from the companies themselves, hear what they see is going on, what they think is going to happen in the next couple of months, and kind of really get perspective for, how the business is doing. It's a very dangerous game to just trade off initial numbers and hope that you're right. Not a good trading strategy. And so even JP Morgan, Jamie Dimon, who is the CEO for JP Morgan, he has been pretty negative over the past 6 months, I would say, 6 to 9 months. Every time he talks, the market generally goes down. And, this past, during the earnings call, he said that he thinks that, we might have a mild recession where the economy slows down. We might trickle into a recession and then have a recovery. Not something that we experienced in 2008, nothing that drastic. So, it's important to be patient. It's important to kind of get that perspective for the companies that you're invested in. Remember, you're not invested in these companies to just try to make it 3 months. You're invested in these companies to make it 3 years, 13 years, 23 years, whatever it is. You got to have a longer time horizon on that. And so kind of brings me to my next point, which is why I named this episode Changing Lanes. And I wanted just to talk about investment strategy. And it doesn't matter if it's, stocks like we talk about, it could be real estate, whatever it is. If you go and you look up in different investment strategies, there are a lot of different investment strategies out there that can help you get to where you want to be, which is financially independent, wealthy, whatever it is. There are a lot of different strategies that you can use, different tactics you can use. And I just want to talk to you a little bit about making sure whatever strategy you pick that you are consistent with it. And so we all know the analogy or the metaphor of, you're in traffic, your lane's not moving, you decide to switch lanes because the other lane's moving. You finally get over there, you switch lanes, you cut somebody off, and then all of a sudden that lane stops and the lane that you were in keeps going, and you're sitting there going, geez, I shouldn't have switched lanes. Same thing happens at the grocery store, right? Every time you switch lanes, it almost seems like the other lane starts to move. Well, the same thing can happen in investing. And so especially when you have a year like last year, where obviously it wasn't very good. Last year was specifically bad, depending on what kind of investments you had. I mean, they were all pretty horrible. And it's a natural reaction to just say, man, I got to switch strategies. What I did last year didn't work. But what if it worked the 4 years before? Now, it doesn't mean you can't alter it a little bit, and we'll talk about that here in a minute, because you are going to have to alter it a little bit, but changing strategies completely is normally not a good idea. And so when I have clients or people or students, asking me, or different investors asking me about what strategy they should use, it's really about learning about the different kinds of strategies that are out there, whether it's technical analysis, fundamental analysis, and figuring out which one of those strategies is most complementary to your personality. And so, sometimes people have the personality of a day trader. Not saying you should do that, but some people have that personality. You have to know your own personality, the things that you're good at, the things that get you in trouble, and you really have to set yourself up for success, and you have to be honest with yourself. And so I know I quote Warren Buffett a lot. I teach his principles. I've studied a number of different investors, and the reason I like Buffett is because it matches my personality. I don't have the personality of a day trader. That is not something that I want to do. I like thinking about planting seeds today that are going to grow 20, 30 years from now, making money while I sleep. When I think about day trading and technical analysis, there's a lot of work that goes into it. It can become very exhausting. And, a lot of times, most of the day traders friends of mine, professionals, it is a tiring, exhausting kind of deal. If you're doing it all the time, that is not my personality. And so you have to think about how much risk you're willing to take, and for the most part, when you look at different strategies, the key really is consistency. It's the same thing that we've talked about for a year. It's being disciplined, being consistent, making sure that you're doing the same thing over and over again. It's when you start switching every, 3 months, 6 months, every year, you start switching strategies and you're doing this start stop. It's really hard to build momentum doing that. And that's not just in investing. I mean, you've seen people that do that in business where they do this idea for a little bit. They're just about to get to, where they're starting to see dividends from it, and they switch. And they start this other new business because it looks like it's shiny and new and it's going to be better. And, you at some point, you got to, stick with the strategy that you think is going to be the most beneficial, because over time, the consistency is what's going to matter more than the strategy. So really think about that. Think about not changing lanes. You look at last year, the NASDAQ had the worst year of any of the indexes. Excuse me. The NASDAQ had the worst performance of any of the indexes, and right now it's leading the market. And so when you look at, if we have inflation come down, if we have the Federal Reserve pause rates at some point, that means that, money is going to start moving around, and investors' money is going to go from kind of the safer stocks, the Pepsi's, Coca-Cola, Procter & Gamble, Johnson & Johnson, United Healthcare, and it's going to start flowing back into some of the riskier ones, Amazon, Google, Apple, whoever. And so, it's probably not going to be like the crazy risky ones that you saw, like, the cryptocurrencies, the those kind. I don't think that's going to happen this week. Again, you had, you probably remember the Winklevoss twins. Geez, say that 5 times fast. They're the ones that you probably know the name. They're the ones that them and Mark Zuckerberg fought over who was really the creator of Facebook. And so if you remember that movie, they were the ones that had the idea. But they also created a exchange called Gemini, a crypto that is currently getting shut down and sued by the SEC, where it says, as of today, the Gemini Earn retail investors have still not been able to withdraw their crypto assets. We allege that Genesis and Gemini offered unregistered securities to the public, bypassing disclosure requirements designed to protect investors, SEC Chair Gary Gensler said in a statement. So that really risky stuff, I think that is a house of cards that is going to dissolve, I think. And I'm not saying that all of it will go away, but there will be. It'll take a while for that to come back. If you watch Netflix, there's a new series on there about Bernie Madoff in 2008. We've talked about him, but if you want to see the video version, it's pretty tremendous on Netflix. They do a really good job of just talking about how he did it. When I watched it, I've read a ton of books on it. I've seen, listened to different podcasts, and I just can't even imagine the amount of effort that went to keep that thing going, and just the amount of people that got hurt. Gosh, it's been 15 years, and it's weird how the river of time keeps going and how quickly you forget. But when you see that, it just reminds me of Enron in the early 2000s and how many employees got hurt by that and lost their 401ks, and this whole thing with FTX and just there's real people getting hurt. They're losing their life savings. I mean, it is not pretty, but anytime you have these big market corrections, you really kind of figure out who's been maybe not as honest in the system as possible, because they can't keep the values up when all the values have been cut in half or dropped 90%, and you just can't keep it going. So it'd be interesting. We'll probably see this saga going on throughout crypto, throughout the year, and it'll be something for us to watch. So, but going back to the kind of the topic at hand here, it's a good time to analyze your strategy that you're using. And if you look at your portfolio and you're like, I have no idea what my strategy is, well, that is when you need to talk to somebody, get a strategy, think about. I would say think about yourself, your personality. Are you a risk taker? Are you more cautious? Are you do you need kind of a little somebody to push you? What are you you know, how do you think that that you would react to, how did you react to the market correction last year? Normally, when you look at male versus female, young males are historically the riskiest investors on the planet. And they get married, they start having a family, they start dialing it back, they get a lot more kind of tame with their investment strategy. Women historically need a little bit of a push. They need to take more risk than maybe they're comfortable with. Guys tend to need to like dial it back. And so, just kind of think about what kind of companies do you like to invest in. I personally, most of the companies that I own are going to be dividend paying companies. I like the thought of getting paid to wait or paid while I own an investment. Now, I do own Amazon, I own Mercado Libre, I own companies that don't pay dividends, but 75-80% of the companies I do own do pay a dividend, because I think over time those dividends, they start to add up. You get compounding with those dividends, and it's a snowball rolling down a hill. And you got to have the patience to be able to start to see that. But over time, it can make a huge difference on your portfolio. And especially if you look at a year like last year, where you have the market getting seriously beat up, if you own companies that don't pay dividends, you suffer a little, you suffer more than those companies that don't. Because normally, if a company pays a dividend, that's going to act as kind of protection for you as the stock drops, because as the stock drops, the dividend yield actually goes up, because you have to remember that just because a stock moves down, that doesn't mean that the company is going to reduce the amount that it pays on its dividend. So as the stock drops, the dividend yield actually goes up. And so you'll have investors that'll say, oh, I can buy so-and-so company with this dividend yield. That's pretty tremendous. That's the highest dividend yield they've had for 4 years. I'm going to go ahead and step in and buy that because I want to get that yield. And so that acts as kind of, downside protection for those kind of stocks. And so historically, dividend paying stocks are not going to get beat up as much as the companies that don't pay dividends. So it is something that you need to think about when you're looking at the investments that that you're choosing. And so getting educated on different strategies that are out there. Listening to this, I can cover more dividend or more investment strategies, but it's all about just getting an education, right? Getting an education in how the market works, how different strategies work, and learning about, you can learn about day trading, you can learn about, just different asset classes. And then once you get that education, you can say, okay, I have this good broad education. Which of these do I think I would be most comfortable with? And that's the one that you really start to lean into. And just a reminder here, I know I've said this before, but I just really want to bring this up again, is you really have to understand how the industry works. So used to, when you'd make a trade, a company would get a commission, right? Every time you'd make a trade. Even when online trading first started, companies like E-Trade, Schwab, TD Ameritrade, Scottrade, when it was around, they would charge you $7 a trade, right? That would be a commission that they would get. And so when they go to this zero trades, these companies they're compensated by you trading more. And so you have to be careful not to kind of fall into that trap. Even the government, for example, if you own a stock for less than a year and you make a gain on it, the government charges you short-term capital gains, which is whatever your current tax bracket is. They are going to charge you that. If you own it for longer than a year, then it's long-term capital gains, and depending on your tax bracket, that could drop significantly. So the government's incentivized if you trade more. The companies are incentivized if you trade more. And so that's why all these commercials, all these videos talk about take advantage of the market moves. I'm going to sell you this system. It tells you when to buy, when to sell, all these things. Take advantage of this, take advantage of that. I mean, it is really hurting investors' performance by having all this activity all the time, especially if you are, maybe inexperienced or learning. It is just something you got to be very, very mindful of and careful of. So, okay, I'll get off my soapbox, but I'd really just, less activity. Normally, you do a much better job if you try to create less activity in your investment accounts. So again, don't change lanes. Be consistent, be steady, make sure you're putting money back into your accounts, paying yourself first. You're the one doing the work, so please pay yourself first. And I hope this is helpful for you. As always, I appreciate you listening. Thanks for all the engagement we've been having on social media. It's tremendous. We have good content coming your way, good interviews. It's going to be a great 2023, and I hope you have a great week. Don't mistake activity for achievement. And I'll see you next time. Thanks, everybody.